PayPal Holdings Inc. ticker symbol PYPL is currently trading at $73.88 a share. Over the last year, it is down 36.4%, but if we go to the last 5 years, this stock has been on one heck of a ride. At the bottom of the pandemic, it was $86 a share, rose to about $308, which is a 250% increase, and has then dropped off massively, 76% down since the middle of 2021. So what we're going to be doing today is looking at my stock valuation spreadsheet. This is my automated spreadsheet to bring in the company's financials. Then we'll look at my models for valuing stocks, discounted free cash flow model, the Ben Graham formula, and the comparable companies model to see if PayPal is a buy or a sell. Now, this stock has been a pretty much favorite of the online community, and even then, if we look at Kathy Woods, she can see her PayPal holdings and had made a massive loss. She was buying all the way up to 2021, purchased 2 million shares, and then started selling as the stock dropped off. And now, as we said at the start of the video, it is about a $73, $74 stock. Can it get back to those previous highs? Well, let's have a look at some of the numbers. First, we'll look at my stock summary sheet. If we type in the ticker PYPL, this will load up the company's financials. $83 billion market cap, P ratio of 53, 35.37, earnings per share of $2.09, and a beta of 1.3. They do not pay a dividend, so I'll not be talking about that. If we look at the revenue here, revenue is increasing 15.5 billion to 27.5 in 2022. So this is pretty good growth, 15%, 20%, 20%, and then 10%. Good revenue growth for PayPal. Net income, yes, it has grown, but it's dropped off quite dramatically in 2022. It went from 2.1 billion, 2.5, 4.2, 4.2 again, and then back down to 2.4 billion. In terms of shares, are they buying back their shares or issuing more shares? Well, PayPal are actually rewarding shareholders by buying back their shares. You can see they've sort of bought back about 0.1% each year and then had quite an aggressive buyback in 2022. So depending on actually when they were buying them back, turns out it was a great decision here. Obviously, the stock price was massively inflated to what it is now, and they bought back in 2022 when the stock is at the lowest it's been in almost 5 years. So that was a good decision for PayPal. And then finally, we'll look at the free cash flow. Is it increasing? Yes, but not very much. 4.7 to 5.1 billion. You can see they had a big jump up in 2020, dropped down in 2021, but then is back up again in 2022. Why do we care about this? Well, they can use the free cash flow to pay dividends, which obviously they don't pay, but then they can also reinvest that back into the company to grow. So let's have a look at our first model. This is the discounted free cash flow model. And what we do is we calculate the future free cash flows and discount them to today's value. And you can see based on the future free cash flows of PayPal, this estimate here, it actually gives it a fair value of $162 a share. Now let's have a look at the numbers and see if we think this is right. So in terms of revenue growth rate, well, PayPal has grown at about 13, 17, 15, and 8%. So I think a 10% is okay, but let's just be a little bit more conservative. Let's see if they can repeat their growth in 2022. Net income margins, you can see they're about 13% to 8%. We'll bring this down a little bit lower to 13%, and you can still see this is a $132 stock based on that. And the net income to free cash flow, even if we go to the lowest number, which is 2021, that brings us 117%. It is still a $94 stock. This will be free cash flow of 4.8, 5.2, and 5.6 billion in the coming years. So discounted free cash flow, very surprisingly, does like this stock. Just before we go into the Ben Graham's model, can you please give a like on the video? Really helps me out. And check out my Patreon. Links are in the description if you want access to this sheet, or I have other sheets like this for a lesser cost, but they still have a lot of value for you to use. Next, we look at the Ben Graham formula. This is created by Ben Graham, the father of value investing, and this looks at earnings per share, growth of a PE growth of a non-growth company, corporate bond, and then the current bond yield. And if we look at the the expected growth of PayPal, analysts think they're growing at about 14.6% over the next 5 years, which looks pretty reasonable. As you can see, they grew at about 16.3% previously. So let's add this into our sheet, 14.5%. And this gives a Graham price of around about $43 a share, a fair value of 43, and then a Graham price of 32. So this stock is way above that. Ben Graham does not really care for this, and I'm guessing this is due to its low earnings per share relatively, despite its high expected growth. Then what we'll do is we will look at the comparable companies model. What this does is it looks at similar companies in the similar industries and sizes, looks at these metrics here, which is EV to revenue, EV to EBITDA, and PE. And then based on the averages of these, we'll calculate the intrinsic value based on the stock. So in terms of competitors for PayPal, well, the first one I look at is V, which is Visa Inc. Next, we'll look at MA, which is MasterCard. Or MasterCard, depending on how you pronounce it. And then another one I was going to look at was Square, but they do not have a PE ratio, and the EV to EBITDA is negative. So if we were to look at the EV to revenue of PayPal Holdings, you can see they are much lower than Visa and MasterCard and similar to Block Inc. So what we want to do is see a much lower number here. And as you can see, it is definitely one of the lowest, which is why it gives an implied value of $206 a share. Let me just see if we can have a look at another one. Another company that is similar is PaySafe. And once again, they do not have a PE ratio, but you can see it is a similar number here, and once again kicks out a value around about $205 a share. Next, we want to look at EV to EBITDA. What we'll do is we'll actually take out this extra company and we'll just compare with Visa and MasterCard because of the numbers. Then we look at EV to EBITDA. It actually has the lowest number of EV to EBITDA, which is what you'd like to see, but it only gives a fair value of $65 a share, which shows based on this metric that all these companies are overvalued, even though this has the lowest number. And then finally, PE ratio. PayPal has the largest of 35, 31 for Visa, 34.7 for MasterCard, and gives a fair value of $71.52 a share. If we take an average of them, it's around about $133 a share, but obviously massively skewed by the EV to revenue number. So overall, all of the models do think it is a buy. Sorry, not all of the models. 2 of the 3 models think it's a buy. The discounted free cash flow model, the comparable companies model, and the Ben Graham formula says no. Right, guys, thanks for watching. Please give a like on the video if you enjoy it. Subscribe if you're not already, and I'll catch you guys next time.